our next guest has put out a report, and before I introduce the guest, I'm going to refer to the cover page of that report because I thought the artwork really depicted very well what we're seeing. So you can see this bull trying to climb the peak and completely out of gas, this exhausted bull trying to climb up, and I think that typifies what's in the rest of the report and how the market's feeling. So Gautam Duggad, Head of Research, Motilal Oswal Institutional Equities, welcome to the show. And let's talk about this exhausted Thakawa bull and trying to climb the mountain of this market. And you start by saying that this is basically going to be a tough time going ahead.
Hi, Tawana, good morning. Thank you for having me here. Yes, in the last 6 months, if you see, a lot of things have changed. Till about 6 months back, we were talking about very strong macro-micro combination with very stable currency and rising forex reserves and very little geopolitical tension. I'm sure, few of the wars were ongoing, but they've become recurring themes nowadays. But post September, October, a lot of things have undergone some mild transformation. Like, for example, if you look at the GDP growth rate itself, 5.4%. Earnings for the first time in last 5 years, we are seeing a significant cut. That's again been a story throughout April till now. But currency has become a bit of a wild card of late. Of course, we are still overvalued on a relative basis, but it's been a vertical fall in the last 15-20 days. And on top of that, monetary tightening because of the way currency was being defended prior to January. So that has also affected growth in a way. So a lot of marginal changes at the margin rather, which cumulatively adds up to a very sobering narrative now. Finally, we are having that correction which everyone was waiting for last 3-4 years. Till July, September, you got correction, but after 2-3 days of correction, things got bought into. This is the first time I can see in the last 4-5 years after March 20 that we are seeing some sort of durability to this correction, wherein indices have corrected more than 10%. But within the index, whether you look at Nifty Midcap 150 or Nifty Small Cap 250, if you look at index, then there are at least 20 stocks in Nifty which have corrected more than 20% from the top. In Nifty Midcap 150, there are more than 50% stocks which have corrected more than 25%, while index is down anywhere between 10 to 12%. And similarly, in Nifty Small Cap 250, there are more than 130 odd stocks which have undergone more than 25% correction from their September highs. So index in a way is still masking the pain. The pain in the portfolios is much higher. And to go with this, you've also seen earnings softening. We are talking about a year of 4 or 5% earnings growth, and there's still 3 months to go. So if there is a 1% or 2% downgrade from here, you're talking about almost a flattish year. After 4 very solid 21% earnings CAGR years that we have seen between FY20 to 24, this is the first year of a single-digit growth. And more importantly, after 4 years of virtually no downgrades in earnings from the beginning of the year to the end of the year, this is again a first year where we have seen 8 to 9% earnings downgrade already. So yes, the bull that is depicted on that picture is in a way reflecting the condition of the market, that after 4 very solid years, there is some breathing space which is needed, and which is what market is right now going through.
You've positioned it as a positive, breathing space. Fact is, you've cut the Nifty EPS 0.6% for FY25 and 1.7% for FY26. And there's some interesting tweaks in your model portfolio. Let me first come to you on the EPS cut and the rationale for that.
So, Tawana, look, if you look at what has happened in the last 6 months, the capex has also undergone a bit of a slowdown. The first 8 months, that is April to November, the government capex spending is down somewhere close to 12.5%. So versus a budgeted spending of 11.1 or 11.2 lakh crore, the first 8 months have seen a spending of about 5.1 or 5.2 lakh crore. So after effects of that are also visible in earnings cut now. Second, consumption has been very weak for more than 3 years now. Of course, we keep debating within consumption, rural theek hai or urban is doing well or that, but as a broad brush, consumption has been very soft. And because consumption is such a big space, within that space, you will always find some sectors or some bottom of stories which are doing exceedingly well. So, be it hotels or jewelry or some select stocks from various subsegments. But the point is, at a top down level, consumption has been very soft. So, that is also getting reflected in the earnings. And the bigger damage or rather, cut that has happened is because the best of the asset quality in the financials is behind us now. So in terms of the base comparison now for FY25 or FY24, the financials earnings is growing at only about 10% on a full year basis. And for the quarter, we are looking at a very flattish earnings for private banks, about 2% growth in earnings, right? Next quarter onwards, probably even the PSU banks will start softening. So the space which has carried the index forward in terms of earnings for last 5 years, where earnings for financials have gone up from 50 odd thousand crores to almost 3 lakh crore on a 6 year basis between FY19 to 25, is now slowing down at about 10-12%. So in a way, it is reflecting the slowdown in the credit growth too, which is obviously something which RBI also wanted because the credit growth has gone up to 16-17%. They were not very comfortable with unsecured loans growing at a very fast clip. So that has come down now. And the whole credit growth itself is down from 16-17% to about 10-11% now. And then you have not seen any support from commodities because the commodity prices have also been very range bound. So four different segments of the bigger components of earnings within Nifty, which is consumption, capex, financials, and commodities, have not had any positive tailwinds in the last 6 months. So what is carrying the earnings forward are some of the smaller sectors, like say pharmaceuticals, at the margin IT because IT is growing at 8-9%. And then you have, capital goods, again, very select companies which are doing well there on earnings. We have not seen earnings upgrade even in capital goods in the last 3 to 5 months. So that is why you are seeing some damage there. So we've got earnings for FY26 for Nifty by about 1.5%, for 25 by 0.7%, as you mentioned. So now we stand at 1,050 rupees for FY25 and 1,220 rupees for FY26. And I still see some more downside to earnings estimates as we move forward.
So Gautam, therefore, one, what's the multiple that you give on FY26 basis for this kind of growth, right, in the phase that we are in? And even if that means, therefore, that the market may stay sideways to maybe have a bit of a downward bias from where we are right now or where we will be in 3 months' time's average, could some of those pockets that you alluded to, which are not seeing earnings downgrades or seeing upgrades, the likes of healthcare, etc., meaningfully outperform, or is market performance a victory in the current landscape?
So, Neeraj, look, in a market where earnings are not growing much and where the forward revisions are not on an upward direction, the market tends to get narrow, right? So, as many of your guests might have told you in your interactions, and even we've been very vocal about it, that in the current context, large cap looks the most promising. Though they are not very cheap, they are in line with their long period average. But that in itself makes them relatively very attractive over mid caps and small caps, which are very expensive even now. So after the 10-11% correction that you have seen in the mid and small cap indices, the mid cap index is still trading close to 30 PE. Small cap index is trading close to 23-24 PE, and Nifty is trading somewhere about 19.5 to 20 times. So if you are looking at valuations, if you are looking at a moderating earnings growth environment and a lot of uncertainty, both domestically as well as globally, with Mr. Trump said to assume charge, then we have budget. We don't know which way the capex allocations will tilt for FY26 because the fiscal space for this government is also very limited now because they are committed to 4.5% fiscal deficit target. And at the margin, your nominal GDP is also slowing down. So therefore, to that extent, the fiscal levers which are available to government to maneuver or to propel the growth is very constrained.
Sure.
And at the same time, you're also looking at a currency. So even monetary easing, you cannot have much of that in play right now. So in such kind of market context in the past, you would have seen market tends to get a bit more narrower. And wherever there is lack of earnings visibility, those space tend to underperform in such environment. Till about July, even companies or sectors which were not delivering earnings, market was very forgiving. Post October, market became very democratic. You've seen huge reactions to companies which have not delivered.
Right.
Even yesterday, I don't think SCL Tech numbers were that bad to get a 9% downtake.
Yeah.
Of course, we have it in the model portfolio. To that extent, I'm biased towards it. But all I'm saying is, you've not seen earnings cut off more than 3%, even for
Got it.
SCL Tech, if you look at a consistent number. The
Got it.
market is in a different mood right now, given where the valuations and earnings equation is settling down.
So Gautam, okay, here's my question then, because it's a large list, right? If you were to build out the ideal portfolio, where is it? What is the first amongst equals, wherein the promise of earnings growth or earnings is higher or earnings disappointment is lower, and the valuations are baking some of these in providing good opportunities? Because in a lot of companies where earnings growth is strong, but if valuations are sky high, investors may not make money, right? So I'm trying to understand, where is it this growth value mix is the strongest as we begin 2025?
So there are very limited pockets like that, Neeraj, to be honest, because while last 10, 15 days we have seen some correction, but the starting valuations have been so expensive in mid and small caps that even now they are very, very richly valued. So like I was telling Tamanna, large caps look relatively far more attractive today. Now, which are the sectors? I mean, in our model portfolio, that's what we've tried to do. Today, we have a 76% allocation to large caps. So what we have done, we have gone back to underweight stance on banks, given the moderating growth, right? We have only ICICI Bank with a big overweight stance. But the sector which looks slightly more promising in today's context is IT, both on a top-down and a bottom-up basis. Top-down because the US growth will start getting more and more prominence under Mr. Trump. And we have seen commentaries for last 2 months indicating that there is some pickup in discretionary spending. It is with this thesis that we had upgraded the sector to overweight in July and then double upgraded it in October. We are maintaining that overweight stance. So you will see around 4 to 5 IT stocks in our model portfolio, the likes of Coforge.
What would be the most loved, Gautam, just on IT? What would be the most loved?
So we positioned LTIM as our top idea for the calendar year 25. So across the team, there are about 10 to 12 stocks from different sectors that our team has already released as CY25 top ideas. So we have replaced Persistent, which has done exceedingly well since we added in October with LTIM. And we continue to like Coforge in the mid-cap space. So these are the two top ideas that we have in the IT space. The second space, which looks very promising, is Pharma. This will be the 7th consecutive quarter of 15% plus earnings growth. And even for FY26, our analyst is penciling in about 18 to 20% growth. So there also we have a big overweight stance with names like Sun Pharma, IPCA, Global Health. The third sector, which is a bit small in terms of the size, but much larger in terms of the growth, is EMS, right? So again, this is a quarter where we are expecting more than 100% earnings growth. And our expectations for next 2 years is also upwards of 50% plus earnings growth. So we have Dixon in our model portfolio. And then Neeraj, as always, we've been biased more towards consumer discretionary while keeping an underweight stance on consumer staples. So within consumer discretionary, we've added Trent. We've replaced Zomato with Trent there. We continue to have Indian hotels, Titan, Metro, and Page is incrementally our top idea for the calendar year 25. So we have a lot of names in the discretionary consumption space. And then we have overweight on telecom, we have overweight on real estate. We still have overweight on capital goods, but a large part of that overweight resides in L&T, where valuations are very attractive because the stock has done nothing in the last 12 odd months. And where are we underweight? We are underweight on commodities. So metal, oil and gas, cement is an underweight stance for us. Private banks is underweight. Yes, within financials, we are overweight on capital marketplace, non-lending financials. So we added a BSC, which is incidentally also the part of top idea list for calendar year 25. And we continue to hold Angel there. So this is the broad picture of our model portfolio, which indicates how we are thinking about the year, where bias is towards large cap and sectors where the earnings visibility is high.
Fair enough, and very comprehensive response there, Gautam. I'll just add one question, and of course, you're starting off the year with this, but then a lot of uncertainties or new elements may come in, including on 1st of Feb. Let me just get your perspective, since we are just a few days away, less than 2 weeks away. What are you expecting to see in the budget, and what out of that could actually change your perspective or lead to more additions?
So, Tawana, basically, if you look at the way markets have behaved around budget in the last 5-6 years, it is prudent to go with zero expectations. This government has shown a very remarkable discipline around fiscal consolidation. So I don't think they're going to veer, too much away from that path of fiscal consolidation because they have achieved it with a lot of focus over the years. So I don't think even if they want to do some growth measures, they don't have too much of space left with them, as we were discussing, because the nominal GDP has gone down by about 150 basis points, and you have committed to 4.5% fiscal deficit. Let's say they want to stretch that 1 year forward. Instead of achieving that by FY26, they want to do it in FY27. Even then, the incremental benefits that you can have are very limited, because we are not talking about an economy with a GDP of somewhere about 355, 360 lakh crores. Now, on that, if you were to spend 40, 50,000 crore extra as a freebie or as a relief to middle classes, possible. But there are no big elections around the corner. So therefore, government's incentive to rush to do that is also very limited. Perhaps what one can see is, because this year's capex budget is definitely going to be missed. So some of that will spill over. Let's say they've committed to 11.1 last year. If they end up doing 10, that will be good achievement, because first 8 months they've done 5.1. So which basically means that the next 3 months you still have a very strong growth on capex, because you're going to spend about 5 lakh crore in the rest of the 4 months if that happens. And then they can, for next year's budget, allocate about 11.5 lakh. So that will look optically very strong, because it will still be a 15% growth on a reduced FY25 delivery of capex expenditure. Beyond that, I won't have very high expectations, because nowadays budgets become a bit of a non-event.
That's interesting to hear you say that, Gautam, because a lot of people that we've been talking to say that for once you can't go with that standard, this budget is a non-event, because perhaps the expectations to come in and do something has increased.
See, pre-budget, everyone feels that there is something definitely going to happen. You look at the last 4-5 years, 50 days ahead of budget, there is the air is always pregnant with possibilities of what can happen in the budget. And this time, obviously, this is the first budget of the new term of this government. So, and then, of course, in the last 3 months, the narrative around growth has slowed down. So people do have expectations. All I'm saying is, do not go with too much expectations, because the possibility of disappointment if you do that. If you go with zero expectations, anything mildly positive, you won't fret too much about it.
Gautam, thanks so much for joining in. Sat on the sidelines for this one, but enjoyed the conversation nonetheless.